What if I told you the market is already warning us, weeks before stocks and crypto even react? This isn't a stock chart. It's the bond market. And every time this signal spikes, something breaks. So the real question is, what is it warning us about this time? By the end of this video, you'll understand how this signal connects to derivatives, the 2008 financial crisis, and why 2026 could be even more dangerous. You ever get that feeling that a storm is coming, long before the first drop of rain? Well, in the world of finance, there's a signal that does exactly that. The derivatives market, that's the superhighway. It's where a tiny problem can travel at lightning speed and morph into a global catastrophe. We saw this play out in 2008, and the big question we're tackling here is whether that highway has gotten even bigger and even faster since then. Okay, at its absolute core, a derivative is just a bet. It's a contract, and its value depends entirely on the price of something else, what they call an underlying asset. That could be anything, really. The price of oil, a company's stock, or, and this is critical for our story, the value of thousands of home mortgages all bundled together. But it's not the bet itself that's the problem. It's how the bet is structured. It all comes down to one incredibly powerful and dangerous concept: leverage. Look, in the cash market, if you want to control $1 million worth of stock, you need, about $1 million. Makes sense. But in the derivatives market, you might only need $50,000 to control that exact same $1 million position. It's like using a tiny lever to move a giant boulder. It's incredibly powerful. And yeah, it can amplify your profits. But it can also amplify your losses into a complete catastrophe. So what happens when that super leveraged bet goes sideways? Well, it triggers this terrifying chain reaction called a liquidity spiral. First, the value of the thing you're betting on drops. Then, bam, your broker hits you with a margin call, demanding you put up more cash, like right now. If you can't, you're forced to sell other stuff to raise the money. That forced selling pushes prices down even more, which, you guessed it, triggers margin calls for other people. It's this violent, self-feeding downward spiral, a fire that just keeps consuming all the cash in the system. Now, this is not just some textbook theory. This exact mechanism was the beating heart of the 2008 financial crisis. A problem that started with American homeowners somehow became a full-blown global meltdown. How? Because derivatives were the transmission belt. The recipe for the 2008 disaster had 4 key ingredients. The spark? A huge U.S. housing bubble. The fuel? All those risky subprime mortgages given to people who really couldn't afford them. The bomb? That was Wall Street bundling these mortgages into these complex securities. But the detonator? The thing that wired all of these bombs together and spread the risk way, way beyond the U.S. housing market was a derivative called a credit default swap. And you know who the biggest seller of these swaps was? AIG. At its peak, AIG had written insurance on over $500 billion worth of the stuff. They were just collecting the fees, thinking the risk was practically zero. But of course, the housing market turned. Those mortgages started to fail, and the value of AIG's insurance absolutely cratered. On paper, they were suddenly facing over $28 billion in losses just from these swaps. Their trading partners demanded massive margin calls, and AIG simply did not have the cash. AIG wasn't just a victim here. It was a super spreader. AIG was absolutely central to the whole catastrophe. If it failed, it would have set off a domino effect, wiping out banks all over the world that had bought its insurance. That's why the US government had to step in with that massive bailout. So how on earth could one company take on so much risk that it could hold the entire global economy hostage? The answer is simple, and it's terrifying. The little corner of AIG making all these bets, AIG Financial Products, was operating completely in the shadows. It wasn't subject to any real oversight, any real rules about how much cash it had to hold. It was a multi-trillion-dollar blind spot right in the heart of the financial system. So the 2008 crisis was this epic, historic wake-up call. It led to huge reforms, things like the Dodd-Frank Act, all designed to make sure this could never, ever happen again. The system was fixed, the loopholes were closed, the risk was gone. Right? Well, not quite. And that brings us to the next piece of the puzzle, shifting the risk. Because what actually happened after 2008 wasn't really an elimination of risk. It was more like a relocation. The reforms created this illusion of safety, but they really just moved the danger from one part of the system to another. You see, the whole structure of the system changed. Back in 2008, risk was spread out in this dark, tangled web of private deals between banks. Nobody knew who owed what to whom. Now, the new rules forced most of these trades into what are called central clearinghouses, which act as middlemen. Yeah, it makes things more transparent, but it also concentrates an immense amount of risk into just a few critical spots. So instead of a web, we now have more of a hub-and-spoke model. The system today is arguably more brittle, with these single points of failure that could be even more catastrophic if they go down. Which brings us right up to today, because that new, more concentrated system is now being slammed with a completely different kind of shock, one that it was never really stress-tested for. And this brings us right back to that signal from the beginning. Remember the MOVE index, the fear gauge? Well, this is what it looks like today. The recent spike in bond market volatility has been even higher than what we saw during the absolute peak of the 2008 crisis. This isn't some historical chart. This is the pressure cooker we're in right now. See, the stressor this time isn't housing. It's interest rates. We've just lived through the fastest rate hiking cycle in 40 years. This puts enormous pressure on the system in a couple of ways. First, there's this massive wall of corporate debt. Trillions of dollars worth that has to be refinanced in 2025 and 2026 at these new, much higher rates. And second, there's a gigantic market for derivatives that are just bets on interest rates themselves. Sudden, sharp moves in rates can trigger those same huge margin calls and liquidity spirals we saw in 2008. So, we've seen the signal. Okay, so here's the full picture. 1. The bond market is sending a clear signal of stress. 2. We know for a fact that derivatives are the perfect amplifier for that stress. 3. The 2008 crisis is our proof, our precedent, showing how these things can create a global meltdown from a local problem. And finally, 4. The reforms since then have concentrated that risk into a few critical choke points. So the conclusion here is pretty stark. The current shock from rising interest rates is hitting a financial system that, while more transparent, might also be more brittle and faster to break than the one we had in 2008. You know, after 2008, investigators said that regulators and bankers suffered from a colossal failure of imagination. They just couldn't imagine a world where the entire housing market could fall at once, or that one company like AIG was so interconnected it could bring down the whole system. And the question all this leaves us with is a pretty sobering one. As we watch these warning signals flash again, are we just busy fighting the last war, failing to imagine how this new, supposedly safer system might break in a completely new way?